This is The Real Story with Michelle Makori.
Tonight on The Real Story, are we now in a wartime economy? And if so, is inflation inevitable? What does that mean for your money, the markets, and the future of the American dollar? We're now more than a week into what the Trump administration has called Operation Epic Fury, direct U.S. military strikes against Iran. Markets have reacted quickly. Oil has jumped and equities have turned volatile. Gold has remained strong, but notably, we have not seen the kind of panic safe haven move that usually accompanies a major geopolitical escalation. And history shows us that the real economic consequences of war rarely appear immediately and rarely stay confined to the battlefield. Every major American conflict tends to follow a familiar financial pattern. Government spending surges, deficits expand, debt rises dramatically, and then the economic consequences show up in inflation. And the United States enters this conflict with a debt-to-GDP ratio that far exceeds previous wars. Federal debt now stands at nearly $39 trillion, and annual interest payments on that debt have crossed the $1 trillion mark. In fact, the United States is now spending more servicing the interest on its debt than it spends on the current annual defense budget. And that's even as the Trump administration pushes for significantly higher military spending. Now, at the same time, new economic data is raising fresh questions about the strength of the U.S. economy. Recent employment reports showed non-farm payrolls unexpectedly falling by 92,000 in February, one of the largest declines since the pandemic. And the unemployment rate rose to 4.4%, job losses spreading across industries from leisure and hospitality to construction and manufacturing. So the labor market may already be weakening just as geopolitical tensions threaten to push energy prices and inflation higher. Is this simply another geopolitical shock that markets can and will eventually digest, or are we witnessing the early stages of a wartime economic regime that could reshape inflation, markets, and perhaps even the global monetary system itself? Well, joining me now to unpack all of this and more, as well as the risks and opportunities for investors, is Michael Wilkerson. He is the CEO and founder of Stormwall Advisors, a strategic advisory firm that counsels corporate leaders and governments navigating complex geopolitical and financial challenges. He brings more than 3 decades of experience as an investor, mergers and acquisitions executive, and former managing director at Lazard, one of the world's leading advisory firms. He's also the author of several books on American economic and geopolitical strategy, including Why America Matters, the Case for a New Exceptionalism. Michael, good to have you with us. Welcome.
Michelle, always a pleasure.
All right, Michael, a lot to discuss, but let's focus on what we're seeing from the markets right now. And it seems that the way the market sees this, it basically comes down to oil. How high the price goes, how soon before we get the Strait of Hormuz open, and how long this war lasts. Now, in your recent commentary that you published in the Epoch Times, you wrote, a wartime economy is no longer a hypothetical future scenario to contemplate. It's already arrived. You also add that war is always inflationary. There are no exceptions to this rule. So as I mentioned, most investors still seem to believe, at least what we're seeing from the markets, that this could be a relatively short-lived and economically contained conflict. What's your read?
It's interesting. One of the things I see in this is that the market in this case had time to anticipate the moves. What President Trump, the administration, was doing was essentially telegraphed to the market and telegraphed to Iran leadership for a long time. And so I have to admit, somewhat surprised at the relatively muted reaction in the equity markets in the first day. What's been interesting to watch is as the week has gone on, what have we seen? We've seen a continual rise in the gold price around the world as people reflect the impact on the Strait of Hormuz, when we see the impact that this will have on LNG, natural gas, its knock-on effects into food and otherwise. So I think what we're seeing here is a market that remains optimistic. Equities are down, but not meaningfully, not in the kind of way that you would say they're anticipating a long and drawn out war. On the other hand, the oil price is reacting perhaps preemptively to the risk of a sustained conflict, or at least the sustained closure of in a very important passageway for the world's oil supply.
And that is, of course, the Strait of Hormuz, which you have highlighted is the real wild card in your recent piece. A reminder to our viewers, roughly 20% of global oil flows through that narrow waterway. And we are seeing oil prices spike because that Strait of Hormuz is, in fact, a key oil choke point. About 20 million barrels of crude, condensate, and fuels pass through that every single day. As I said, roughly 20%, one-fifth of the global seaborne oil shipments, a similar share of liquefied natural gas. Now, we've had multiple vessels attacked or hit by Iranian drones and missiles, near the strait. But perhaps even more significantly, in terms of disruption, is that war risk insurers effectively pulled coverage, which is a huge deterrent. They're suspending transits and rerouting because of the fact that they can't get insurance. Now, we have had the president step in here. He said that the U.S. will provide insurance guarantees and naval escorts to ensure safe passage for oil tankers and other vessels through the Strait of Hormuz, and that the U.S. government will help with insurance, that the U.S. International Development Finance Corporation will offer insurance to help ensure that the flow of energy will continue through the Gulf. How easy is it to resolve the issue this way? Do you see this as a viable solution here, Michael? And if so, when can we expect oil to get flowing again?
I don't know. I do appreciate the intention and the sentiment of President Trump's announcement to ask the DFC to provide credit support for the premiums. We saw over the course of a few days, premiums skyrocket to well over $1 million, $2.5 million per voyage, and then just be canceled altogether. It was an intention. It was a statement of intent. The details will have to be worked out. I think at any price, the ability to ship oil through the strait will depend on the actual military situation, and that will depend on a number of factors. Number one, we do appreciate that the Iranian military has been degraded very, very quickly. The vast majority of its ballistic missiles were expended in a few short days. Most of the aerodrome has been shut down, is under U.S. control. Most of the maritime environment is now under U.S. control. But as we've seen in many other scenarios, the ability to launch other insurgency types of attacks could render the strait dangerous for some time to come. And I think shippers and their insurers are going to be watching and waiting for a bit more stability and assurances before they put their lives and livelihoods at risk.
And again, as we said, it comes down to oil and it comes down to timing, how long that this war could last for. Estimates have been for several weeks, at least that's according to the Trump administration. But you have pointed out in some of your work that the timing that presidents usually estimate for conflicts and the reality are very, very, very different.
The timing is usually home by Christmas. That seems to be the promise that gets repeated.
Well, that would be a very long war for this one. I'm sure
for this one, fair enough.
By Easter.
The idea being that if you look back over history at every major conflict in the last couple of hundred years, even in the Civil War, no one really believed or anticipated that the wars would last as long as they did. Think about even our own lifetimes, our own experience in Iraq, in Afghanistan from the U.S. Our leaders, our media repeated at the time, this will happen very quickly. And indeed, it appeared that the Iraqi government capitulated very early, that we had sensible control in Afghanistan. Afghanistan wasn't really a country. It wasn't really run as a nation state. And Iraq also had fallen apart. And we were there in the case of Afghanistan for 20 years, and Iraq for 8, before we had to leave and then come back because of the resurgence of ISIS. That pattern has repeated itself over and over again in previous generations via the Vietnam War, where we were also committed for over 20 years, despite attempts by President Kennedy and otherwise to get us out. Political factors and public relations factors overruled it, and we ended up being stuck in what, of course, is famously called a quagmire. So I do hope that we get out very, very quickly, that President Trump gets what he's asking for, which is unconditional surrender. And with that, while he hasn't revealed what his plans are, some form of government that would be able to provide stability to the nation. What we must not forget in the context of Iraq is that government is a theocratic government. It's based on an apocalyptist view of the world.
Iran, you mean?
Iran. Yeah. that is radicalized and has a view that Israel is the enemy, the Jewish people are the enemy, and they will wage global jihad wherever and however they can. Those who are radicalized by that agenda will find a way to keep on fighting, which I think will make the world uncomfortable for a very long time, to the extent that they can continue to project the kind of terrorist activities and other things. So I've been a little concerned that the optimism that's been expressed by many commentators and actually many colleagues and friends on this side of the pond might be a little premature, that we may need to understand that this could go on for quite some time, despite the degradation of the Iranian military, and the fact that taking over is one thing and actually ruling and ensuring the peace is quite another.
Not just death to Israel, death to America as well, as the regime would often and unequivocally state there, Michael. But let's focus on the economic side of things. And you have said that you think we are already in a wartime economy, and that wars are always inflationary.
Yes.
Explain what you mean by that. What is a wartime economy, and if inflation is in fact inevitable here?
Let me explain why I said that. When I started the year thinking about what are the major drivers, investment themes for 2026, number one at the top of the page was geopolitical factors, what I called wars and rumors of war. What we saw happening beginning really in 2024, accelerating into 2025, and then kicking into high gear in 2026, nations around the world are preparing for war. They are rearming. We have seen the budget here in the U.S. increase to now over $1 trillion for this fiscal year. We've seen Germany and Europe awaken again. We know that China and other nations, Russia, of course, has already been on a wartime footing for half a century now. Half a decade now. But nation after nation is prioritizing defense, rearming. This creates distortions in the economy. It moves resources to those uses. Dual use can actually be quite productive and add a lot of value to the economy, but it does create inflationary effects. And I believe we're already in that position, because here in the US and our allies are already in a position where, through the various smaller conflicts we've been engaged in, whether in Syria, in Ukraine, most recently Venezuela for the US, but certainly where we burned through a big portion of Tomahawk missiles in the first few days of Epic Fury, we are going to be pushing the gas pedal here on spending and replenishment, and that is going to produce inflationary pressures going forward.
Let's focus on the price of oil here, because if that is contained, obviously that is a big factor of the inflation equation. If the Strait of Hormuz is opened relatively quickly, and or oil is released from the Strategic Petroleum Reserve, something that the administration says it's not going to do just yet, but the Secretary of State, Marco Rubio, says that they did expect oil to rise, and they do in fact have a plan to mitigate this. Could the inflation be contained? I mean, we've already seen some kind of motion, for example, the U.S. temporarily easing sanctions on Russian oil sales to India. There's a 30-day waiver that will allow Indian refiners to resume purchases of Russian crude. The administration says that there are steps being taken to mitigate oil price volatility. This was something that they had prepared for. Again, we're not entirely sure what that is, but assuming that the oil price can be brought back down to pre-war levels or relatively near that level, does that mean that inflation from this conflict could be potentially mitigated, or has that ship sailed?
Could be. One of the great things about the position that the United States is in today is we are energy independent, and we are a net exporter of oil. We do have the resources to sustain ourselves through an extended wartime economy. Very different to the conditions in the 1970s, when OPEC was able to put us in a bit of a stranglehold, because we were importing some 30% of our oil from the OPEC nations. Today, that's not the case. You've also mentioned the Strategic Petroleum Reserve. I was a big critic under the Biden administration of draining the Strategic Petroleum Reserve, really for political purposes, in the months leading up to the midterms in 2020, to try to lower prices at the pump. President Trump and this administration has been focused on replenishing it. I don't expect them to use that as a tool Never know. The point of the SBR is for emergencies, true national emergencies. I don't know that trying to implement price controls qualifies. What I would say is that we have a number of resources here that will help mitigate these factors. Oil is a global market, unlike natural gas, and that's a whole other issue, given the closure in the Strait of Hormuz. Qatar basically stating that they're going to cut off supply for some period of time. Totally different issue. That leads into the food inflation question. But to your point, yes, I think the U.S. has the potential to really navigate through this. What troubles me is that energy and oil in particular feeds into everything. Oil or energy inflation drives food inflation. It drives transportation, so many other factors of the economy that if you can't keep oil prices under control, keep energy inflation under control, very difficult to do so otherwise. I say that knowing that we've got deflationary factors coming from AI productivity in other parts of the economy and goods and services as well. But these forces have to contend.
A couple of points. You have been very, very accurate on previous inflation calls during our previous interviews in the past. I will point that out there.
Um,
And you just touched on the idea that natural gas impacts food prices and other products that go through the Strait of Hormuz, not just oil. I believe you did some work detailing exactly what else could suffer as a result of this conflict.
Well, that's absolutely right. So, natural gas is an input into nitrogen fertilizers that goes into basically all of our food products. That market, because of the high transportation costs, is more regionalized. So, the Middle East, Strait of Hormuz, Qatar, basically feeding parts of Asia, parts of Europe, and the U.S. once again is blessed with the ability to be relatively self-sufficient in this area. But the rising cost of oil impacts everything. It impacts food as the second biggest factor. And this is something that we're going to have to keep a very close eye on here. I'm concerned. And one other thing to mention, Michelle, is we shouldn't lose sight of the geopolitical implications here. The shuttering of the Strait of Hormuz has a significant impact on China in particular, where they're receiving where I've seen different estimates, somewhere between 35 and 50% of their seaborne oil is coming from the Middle East, from the Strait. This will definitely impact them. Think about that a meaningful portion, at least 20% of their imported oil has come from a combination of Venezuela, Iran, and Russia over the last several years. On ships relabeled Indonesia, Malaysia, whatever it might be. But they've been very dependent on two of the countries that President Trump has just taken out of the global market and out of their supply chain. So for China, this is a very serious issue, which they're going to have to react to in one way or the other. Russia, on the other hand, you mentioned the lifting of sanctions on a very specific subset, seaborne oil, 30 days, shipments to India, etc. But certainly Russia's fiscal position is strengthened at oil at $85 because they won't be running fiscal deficits anymore. They'll be able to continue to fund the Ukraine conflict and other things, potentially including replenishment of supply to Iran going forward.
Right. So how do you think Russia is viewing this conflict then? Is it a net positive because oil prices are going up?
I don't know that it's a net positive. I named a positive factor for them, that there is a silver lining here. I think it should be concerning to President Putin and to the regime there, just given it's very clear that the Trump administration means business. There's no more talk of taco in the Kremlin. I think that Trump will back down, that he'll check it out.
And taco, for our viewers, the nickname that Democrats gave the president, Trump always chickens out, which clearly he hasn't on this one.
That's right. And so I think it's very difficult to not take President Trump's moves very seriously if you're sitting in the Kremlin. The war has gone on, going to the point of wars never are resolved as quickly. Based on what we know, the Putin administration at the time in 2022 expected the war to be over in a few weeks. They believed that they could march in massive force on Kiev, settle the issue, resolve it, and be home by Christmas. And it didn't happen for a number of reasons, but they're still stuck there in And they've been through this before in Afghanistan. Different story, different situation. But no, I think this is probably not net positive for Russia either, but the rising oil price is.
All right, you touched on what this means for China, and I do want to explore that angle at length and then circle back to some of the assets that could be impacted by this war. But let's talk about what it means for China, because as you said, China has had its cheap, discounted, sanctioned oil severely curtailed, not just from this Iranian conflict, but the actions that the Trump administration took in Venezuela. Venezuela was also providing China with a lot of oil. So one has to wonder whether this has been part of the agenda here, whether cutting off China's access to cheap energy and thereby curtailing China's geopolitical ambitions, curtailing China's economic growth is part of the agenda here.
I'm sure that it must be. I would imagine that there is stick and carrot involved. Stick is, okay, we've now shown you what we can do and can cut you off. The carrot might be, turns out the U.S. is a net exporter of oil. We might be willing to provide China with oil, fill in the gap. But by the way, as a quid pro quo, we need you to start releasing some of those critical minerals, rare earths that you have been withholding from the U.S. and our allies in recent years. Trump thinks, I believe he thinks in terms of negotiation and deals. And so this may be something where there's an opportunity here to actually take down the tension with China and make this less of a sort of binary zero-sum game and more of a how can we ensure that we each get what we need.
Okay, I hear that point. But
Michelle, with the caveat that I don't believe China is ready for or wants a war with the U.S. any more than we do. So they are also still biding their time, and that's probably an important point to add on there.
Okay, and to broaden this into the monetary dimension, any oil that the United States would sell to China would be in dollars. And the idea of protecting the petrodollar as part of this move, as well as the action in Venezuela, has come up that this is potentially another one of the strategic angles behind this conflict. Just as a recap for our viewers, since the early 1970s, much of the global oil market operated under what became known as the petrodollar system. After the United States left the gold standard in 1971, Washington reached agreements with Saudi Arabia and other major oil producers that effectively tied global oil trade to the US dollar. Under that arrangement, oil would be priced and settled in dollars. Countries around the world therefore needed dollars to purchase energy, and the oil exporters themselves would then recycle those dollar revenues back into US assets like treasury bonds, investing in American financial markets, holding reserves in dollars. So you had this loop system, which was very, very positive for the United States and helped reinforce global demand for the dollar and helped finance US deficits. And that was working very well up until around 2018. Up until that point, 95% of the world's oil was, in fact, sold in dollars. There are a number of factors that happened in between, including excessive weaponization of the dollar. But fast forward to now, and around 20% of oil in the world is sold in non-dollars. So that's been very detrimental to the petrodollar system. How much of this is about the United States re-exerting pressure on oil markets and forcing them to price things back in dollars? Do you think there is a strategic monetary dimension to this conflict?
I do. So one of the things that you touched on, but just to emphasize, is around that same time, 2018, China stopped buying U.S. treasuries. Over the past several years, they and other nations have been replacing U.S. treasuries in their foreign reserve accounts with gold. So I think, again, let's look at where the opportunity lies rather than the problem of what could go wrong with it. I think, again, from the Trump administration's perspective, the opportunity lies to reassert U.S. dollar dominance, force the hand of China, or at least try to influence China to, again, take U.S. dollars, build up its position, pay in U.S. dollars, start to think differently about the treasury market. I did mention rare earths and critical minerals. This could be a barter exchange. It gets complicated and messy. So ultimately, probably you're right, settled in some other currency. The expectations for the U.S. dollar to fall away as a reserve currency have been at least premature. I do think long term there are challenges there, but the idea that the yuan, the renminbi, or other currencies are going to take over those global flows has been very difficult, even within the Iran, China, Russia trade interchange. It's been a very complicated mechanism to try to work out. So rather than being a challenge, I do think you're right that this is an opportunity for the U.S. to gain some more time, reassert itself in terms of the petrodollar regime vis-a-vis China. Whether it works or not, who knows?
Right. Well, the U.S. does now have greater influence over the oil flowing, certainly from Venezuela. And if this conflict goes according to the Trump administration plan, it'll also have great influence over the oil flowing from Iran and can then price things in dollars or exert more of the dollar's dominance on the global monetary system. And it's perhaps the reason, Michael, that we have seen the dollar strengthen during this conflict. Why do you think the dollar has been strengthening during this conflict?
I think you have some of the usual suspects of safe haven, flight to quality, flight to value. You may have some dollar milkshake theory issues going on here of looking for liquidity, looking for dollars. The idea that in times of conflict, rather than the dollar falling, that there's pressure as people try to find liquidity in dollar terms. I want to, if I may, just bring in a historical parallel, not exactly the same, but if you think about the conflict with Japan in the 1920s and 1930s, there is an analogy here, which is that the U.S. was taking actions to limit Japan's access to the global oil market. Japan had no natural resource of oil or gas or otherwise, was completely dependent on shipping. And the U.S. administration, for valid geopolitical reasons, made that access very, very challenging. And that did, I believe, accelerate and provoke Japan to taking courses of action that they might not otherwise have taken. And I do hope that the Trump administration looks at that lesson and uses it wisely as they think about trying to leverage it vis-a-vis China.
How much of this back to the dollar, Michael, is about the U.S. flexing its military might and reminding the world why it is the global superpower? And again, this is depending on if the conflict works out successfully. I'd like to remind our viewers that the dollar became the global reserve currency due to American military might after the United States helped the Allies win World War II. Then we had Bretton Woods, which put the dollar at the center of the global financial system. How much of this is about the Trump administration reminding everyone why the United States is the global superpower? Agree with it or not disagree with it, agree with it or not. Is that an agenda here? Because the president had, on previous occasions, when there was talk about the BRICS plus currency, when there was talks about other countries intentionally trying to upend the dollar, he had made it very clear that that was not going to happen under his watch. Could this be part of the agenda? And if this is a successful conflict from the US's perspective, does it effectively extend the lifespan of the dollar?
It will likely extend the lifespan of the dollar. It is, again, there is a precedent here. There is a playbook. So prior to the US dollar being the global reserve currency, the British pound, the sterling, was the global reserve currency. And for over a century, the British Empire used gunboat diplomacy to ensure that the sterling remained the global reserve currency, that they were able to force with the largest navy in the world, markets to open, to take their goods, to pay in sterling, to ensure the same kind of a monetary regime in addition to trade leadership around the world. So there is a precedent. It absolutely will extend it. At what cost over the long term? And that's a more difficult question to answer.
Right. And again, when we say extend, we're not talking about a week or a month. We're talking about the idea that the U.S. empire could be eventually on the brink of collapse. And what we always like to say, what is inevitable is not necessarily imminent. But on this show, we obviously cover the idea that every global reserve currency has a lifespan and has come and gone. and perhaps a move like this could serve to extend that. On the flip side, though, what if this conflict does not go according to plan? What if this does drag on for far longer than anticipated?
Mhm.
What could happen to derail what the Trump administration is hoping will be
Yeah.
achieved out of this conflict?
I think the biggest consequence would be we would see a greater spike in what I've called inflation, and through what I've called the deficit debt inflation doom loop, which is we will run bigger and bigger deficits in order to fund a bigger and expanding war effort that will be funded by debt, which will also then translate into monetary expansion, printing of money through the various mechanisms that the Fed, the Treasury has. Stable coins have proven to be a great boon because the Treasury has found an entire new market of people interested in holding safe assets secured, but with all the benefits of digital cryptocurrencies and otherwise. So, but the effect will be we will see an acceleration or a bringing forward of the inevitability of the challenges to purchasing power for the U.S. and for otherwise. Why? Go back to the earlier point, because war is always inflationary. The cost of war is astronomically expensive and takes a big toll on the economy, not always visible during the years of wartime productivity, because there's an illusion of wealth when you're making armaments and munitions. All of that stuff destroys capital stock. Things have to be rebuilt, but it expends value along the way using an appreciating currency through monetary expansion and money printing.
Right. And that brings us to gold, Michael. Why has gold not really moved dramatically on this geopolitical tension?
Great question. I do share the view of some of the gold bulls out there who think that in this cycle, a $10,000 gold price is not unrealistic. I'm giving you a number because I know you like to have specifics, Michelle, and that I stick with
Now
that.
I have to ask 10,000 by when?
Yeah, and so there's the rub, which is I think it went so far so fast. And the same could be said for silver, that there may be some consolidation that needs to happen, some catch up here. Gold and silver, as you know very well, are trading for different reasons, or the run up has been for different reasons. So for both of them, I am long term bullish, but in the short term, I could imagine a sideways period just because there was so much so fast, perhaps in anticipation, as others were seeing the drums of war. And the market, we got ahead of it. So it bought the rumor and now is holding on the news.
If this war continues, do you expect gold to benefit from that? Or what
Because
timeline? What timeline?
yeah.
If the war continues beyond, let's say, the 4 to 5 weeks that the Trump administration has laid out, do you see gold becoming more of the safe haven play that it typically does during these kind of conflicts?
I do believe it'll be a long-term safe haven. I don't know whether in 2 months much will change. So I think the short-term implications are what they are. Oil is going to be the big beneficiary over this time in the, call it 3 to 6 month period. I would not be surprised to see gold and silver largely sideways before taking off on another leg again. And when would that happen? When there's some evidence of what I was describing. Again, as we always like to say, not so much that gold or silver are going up, but the dollar is going down as some of this inflationary pressure gets priced into the currency exchange rate.
Before we get into silver in a little bit more detail, how does the Fed fit into this picture? Because if we do have inflation rising because of oil, and even if it is mitigated, what kind of action do you anticipate from the Fed? We have a meeting coming up very shortly. Are we going to have a new Fed chair, Kevin Warsh? He's been nominated. He needs to be approved, but assuming he does get approved, what do you anticipate from the Fed during this?
My first reaction when you asked the question was it doesn't matter what they do. In this kind of environment, when these external forces are driving it so hard, the Fed becomes, I hate to say it, but to some degree impotent in terms of its ability to actually make a difference in the monetary policy environment when all these other factors are weighing so much heavier, so much larger. The Fed will be forced, if required, to monetize the debt, to buy the debt that we can't sell into the markets, whether it be to China, Japan, or to stable market investors or otherwise. So I think and Kevin Warsh has been around for a long time. I have a lot of respect for him. I saw him even in action during the global financial crisis. So I think he is going to be as good a hand as any could be with a very difficult situation where the tools in the toolbox may simply not be that efficacious.
Well, what does that mean then? It means that the Fed would continue to
Moderate.
cut and cut into inflation.
Yeah,
What does that mean?
I think, so I do believe that when faced with a very difficult choice of continuing to raise more debt or yes, you have to raise more debt, but do you let inflation run? And the answer is you let inflation run. In other words, if you're faced with the choice of we have to find buyers for this debt and we don't want to monetize it all ourselves, they don't want to be issuing debt at 5%, rolling over at a price. As you mentioned earlier in the program, already we're spending over $1 trillion a year on debt service, on interest expense alone. So we have to get the cost of issuing paper down. And all else equal, the government will choose to let inflation run to be able to continue to finance the deficit.
Well, in the meantime, we're seeing some interesting developments in the bond market. Treasury yields haven't dropped as they typically do during crises. What does that suggest to you?
It's been interesting to watch. I don't think that bonds are going to be a great long-term option in this environment. We're talking about an inflationary period over the long run. You're right that we did not see yields blow out, although today they were up a bit. I don't want to comment on what happened today or yesterday because, in a week the environment will change. But it was muted. I have to be honest. From my perspective, surprised to not see more of a reaction, and I just wonder. Certainly I think there's a bit of complacency and optimism in the equity markets where you're, I suppose, supposed to see it. The bond markets are supposed to be a bit more sober and reflect it. So we'll see. We'll see what happens over the next week or two.
Do you get a sense that markets digest things very, very differently if this conflict is not over in 4 or 5 weeks' time?
I think the market will start to make a more discerning you will view more discerning observations. So what do I mean? I do think that the market priced in some of these actions already, given that it was telegraphed early. So when Epic Fury actually struck, the market said, okay, we mostly anticipated that. Makes me a little nervous. As time wears on, I think you're going to see that creates a greater risk of people running for safety, trying to find other homes. On the other hand, and some of my time right now is spent thinking about in a wartime economy, there are winners and losers. There are winners and losers in the real economy. There are winners and losers in the bond markets, typically always a loser. There are winners and losers for sure in the equity markets. There are many companies that will benefit from a wartime environment. While it's bad for society, it can be good for defense stocks. It can be good for commodities investors. And otherwise, whereas other things, consumer discretionary, et cetera, may fare very poorly in this environment. The question is, will the equities reflect? Will they be able to benefit from a high inflation environment and one in which resources are under greater degrees of government control? Will there be rationing or reallocation of critical resources away from consumer sector towards strategic interests of the nation?
Before we get to your opportunities and the picks you have there, as we start to wrap up here, Michael, I do want to touch on silver because, as we know, silver is essential for modern warfare. It is essential for those Tomahawk missiles that the United States have been firing. And I believe you have the exact number of how many have been fired in this war. And a reminder to our viewers that reportedly, a single Tomahawk missile contains around 500 ounces of silver. That's around 16 kilograms in just one weapon. When that missile is fired, that silver is vaporized. It is gone. I know you have an account of how many missiles have been fired in this war. You've done some very thorough research as part of your work for Stormwall Advisors. And you can share that detail with us. But the big picture here, Michael, that I'm going for is silver is essential for these hypersonic missiles, for drones, for satellite guidance systems, for all of the advanced electronics. And one would think that demand should be surging right now with the way they've been depleted. Yeah. How come we haven't seen this reflected in the silver price?
All right. Well, before we forget it, let me just comment on it. So based on analyst estimates, the U.S. has a stockpile of around 3,500, 4,000 Tomahawk cruise missiles. In the first 5 days, we probably spent or depleted 10% of that. So you can imagine that it won't take too many more weeks until we run through a significant portion. Right now, without surge capacity, which doesn't exist today, the U.S. can replenish about 200 of those missiles a year. So this is a multi-year issue. Compare that with sort of a low-tech solution, which is the Shahed drones that Iran produces around 10 or 20,000 a year, and they're also going to burn through them very quickly. But those cost $20,000 each, $40,000 each, versus the $5 million it costs for interceptors. So we will win the munitions the battle in terms of having a greater depth of supply and the ability to replenish the supply chain. My point is, though, that it's very expensive. We can burn through it very quickly, and it gives me concern, especially if we see conflicts open up on other fronts. As to the impact on silver, silver's been in a structural supply deficit for years, as you know, as your viewers know. This has not changed. There's not been a miracle solution. There are substitutes, copper or otherwise, that can be used in some applications to some degree of efficiency or relative efficacy compared to silver. But silver is important. It's going to continue to be important. We did see a lot of Me Too buying of retail moving into silver, which I think caused part of the steep wall of the climb. We're seeing some settling of that. We've also seen the price disconnect between the spot market, between the commodities exchanges and traded physical gold trading locations in Singapore, Dubai, or otherwise, that come back into a normal range over the last few days. So I don't think that's likely to persist. I did a quick analysis on what would it look like? Could I send physical silver to China, sell it in Shanghai, shipping costs plus tax, zero customs, that's good, 13% tax. There's no real arbitrage opportunity there because of the bulkiness of the product, et cetera. So I think that silver short term continue to see consolidation, but you hit on the main point, which is for many applications, silver is not replaceable. We're not mining enough of it. And that's why I continue to be long-term bullish.
And yet the price hasn't really moved. The president did address the munitions stockpile question. He posted on Truth Social, the United States munitions stockpiles have at the medium and upper medium range never been higher or better. As was stated to me today, we have a virtually unlimited supply of these weapons. Wars can be fought forever and very successfully using just these supplies, which are better than other countries' finest arms. Obviously, we do not want a war that goes on forever. And by we, I mean the United States, I mean the Trump administration, I mean the world at large. I don't think anybody wants that. But the president is indicating that munitions are not an issue at the moment. But either way, they would need to be replenished. And again, you would think that this, combined with what we talked about, a structural supply deficit in the silver market, combined with the other industrial uses for silver, they're actually also used in those drones, the cheaper Iranian drones, but they still require silver.
Yeah.
Many would say that we're seeing manipulation, perhaps by the military-industrial complex, perhaps on some governmental level, purely speculation here, granted conspiracy, in keeping the prices down, particularly during this time.
Wow, on that one, I don't know what to say. I think I've spoken with you in the past about the potential manipulation in the gold market, silver market. Silver was infamously been attempted to be cornered and manipulated on a couple of different occasions. Well, that's probably beyond the scope of this show, but I'm sure you've had other guests who've talked about this. So do I think that is a possibility or even a probability? I absolutely do. Is it going on this week any different than last week? I mean, we saw a few weeks ago when silver was running, to the moon, as we like to say these days. The CME and other exchanges raised the collateral, raised margin requirements willy-nilly. They have the right to do that. That's what the contracts provide. Is that manipulation or is that good market management? I don't really know, but it certainly can very quickly flush out a lot of leverage in the system and slow the rapid rise of it. So let me go back to your main point, though, which is can we fight? Can we fight this forever? Of course, the U.S. President Trump is right. We have greater depth of resources, greater depth of reserve. It's one of the main reasons, if not the main reason, that we prevailed in World War II, is that we could outlast and out-provision Germany or Japan. Just simple. And a lot of lives expended, millions of lives expended to prove that lesson. But it was inevitable that the U.S. would have the ability to persist longer. We probably still do in many, many ways. The question is at what cost, at what consequence? That's what we're here to talk about. And I think certainly for silver investors, this is one of those things where, as terrible as the consequences of war are, one way to protect yourself, protect your own assets, whether as an institutional or an individual investor, is to recognize that the commodity cycle, the impact that war has on these prices, whether it's reflected today or tomorrow, harder to predict for this, whether it be for manipulation or many, many other market reasons. Gold, silver, oil, likely to persist as a valuable play in a wartime economy.
Right. So let's, as we wrap up here, Michael, share some of your opportunities that you see across the board for a wartime economy.
And I think we've gone through a lot of it in that I do believe that gold, silver and oil. So basically the commodity cycle, this is where I am spending a lot of my time and effort. Still a believer in Bitcoin. That's a whole different conversation that we don't need to cover today. But within the portfolio, I think about gold, I think about silver, oil, and also certainly the oil companies, without getting particular names, the resource plays, and then the defense companies and defense tech. So there are the old school defense companies and the new ones, the new kids on the block, the Palantirs, Anduril, others that are providing essential resources, whether it be in the maritime environment, in the aerospace environment. And think about the role that Space Force has already played, even in this conflict. Anything regarding space is, one could argue, a bit overheated right now, that everybody sees the same play. I see maritime as being a little bit of the neglected stepchild relative to space and opportunities there. So I am really focused on what can win in war. And again, noting as terrible as the consequences of war can be, protecting assets and finding a way to grow into it leads me to these sectors.
You mentioned maritime. Obviously, that's coming to focus now with a lot of the war here focusing on the oceans. Do you have any particular companies in that sector?
More difficult to find in the public company sector that are interesting. There are some earlier stage companies that I'm looking at. We are a bit behind now, the U.S., even in our infrastructure, our ability to build and deploy ships rapidly. We did very well at this. We sold off most of our port infrastructure. The infrastructure plays are a little bit different, a little bit longer lived in terms of the return profile. But this is an area where I'm actively looking to understand where the opportunities might be in shipbuilding, in autonomous drones, undersea submersible drones, etc., where there's a lot of activity going on. A little bit early for the public company stage for many of these companies.
Right. And even, again, if this war does wrap up according to schedule, one would still have those defense stocks in their portfolio, I would think would be your reasoning.
I would agree.
All right, Michael, where can people learn more about you and your work?
So you can find all my writings and videos at stormwall.com. You can also find me on X at MW_Stormwall. And for purely business activities, I'm at stormwalladvisors.com. stormwalladvisors.com, MW_Stormwall on X, stormwalladvisors.com.
All right. Well, Michael, thank you as always. Appreciate your insight and appreciate your time. And of course, people can also look up several of the books that you've written, including the latest one, The Case for American Exceptionalism, I believe.
The newest one is a book called Puritans, Pilgrims, and Prophets, How the First Generation of English Settlers Shaped the Future of a Nation. And it is a retrospective to look at that first generation who were caught up in the English Civil War, and came to the U.S. to try to create a new Israel, a new story here on this continent. It's a lost story to a lot of us, but it is an important foundational story about what makes America great and what makes us exceptional. So recommend it. Puritans, Pilgrims, and Prophets.
Of course, you recommend it. You wrote it, but
I
I'm
don't
sure.
regret it.
But I'm sure it's very good, and I know you have a very colorful and engaging style of writing. So I recommend it by proxy. All right, Michael, thank you so much. We look forward to catching up with you again soon. Michael Wilkerson.
Thank you, Michelle.
And a big thank you, as always, to our viewers. If you have not subscribed yet, please make sure to do so. And if you find our content interesting, engaging, informative, educational, which we hope you do, please share it with your friends and family. And as always, we love your comments, even the negative ones. We do read them. We do take note. We don't always agree, but we do read them. So as I like to say, please feel free to praise, whine, or just opine. From me, Michelle Makori, and the rest of the team, we'll see you next time.
This is The Real Story with Michelle Makori.